Inflation quietly erodes your money. That's why people panic. I need stocks, gold, anything to beat inflation. But wait, before making money, you need a financial checkup. In finance, whether you are a company or a potato, you must check your key numbers first. Number one is cash flow. Income flows in, expenses drain out. Cash flow isn't how much you make, but how much is left. Number two is net worth. Assets minus liabilities equals net worth. This is your true wealth. Right now, interest rates are high. That makes debt expensive. Credit cards and loans eat your cash flow. In this environment, debt grows faster than most investments. So the order matters. First, make sure your net worth is positive. Now we allocate free cash flow into 3 buckets. Bucket 1, safety. This bucket exists so you never get forced to sell long-term assets at the worst possible moment just to survive. Bucket 2, spending. This is money you will need in the next year, like rent or monthly bills. The priorities here are liquidity and principal protection. Bucket 3, growth. Only money you won't touch for 3 years or more goes here. This is the bucket you can invest in potentially outpace inflation over the long run. Now you have money to invest. It could come from your paycheck, a gift, or even pure luck. But before we talk about what to buy, let's map out the major asset classes and the kind of expected returns each one tends to offer. Class 1, cash. Today, smart cash sits in high-yield saving accounts or money market funds. In the current environment, you are looking at yields around 3.5% to 5%. This is the home for your bucket 1 and bucket 2. You earn a small return and won't beat inflation, but you can sleep well at night. Class 2, bonds, the shield. Yields range from 3.5% to 4.5%. Returns come from the coupon, the regular interest. Second is price appreciation. Here lies a core concept, duration. Simply put, duration measures sensitivity to interest rates. It's a mathematical seesaw. When rates fall, bonds price rise. So if rates drop, you win twice. You get the coupon and capital gains. That's the power of duration. Class 3, stocks, the rocket. Stocks represent ownership. They are volatile in the short term. Prices zigzag wildly. But historically, they are the best engine to outpace inflation. It offers the highest long-term returns. You are betting on human productivity. Real assets are real estate and commodities like gold and oil. They act as a hedge because their prices often rise with inflation. They protect purchasing power, but they are illiquid. You can't buy groceries with a brick. The holy grail of finance isn't picking the perfect asset, but managing correlation. Stocks and bonds often show negative correlation. When stocks crash, capital flights to safety, pushing bond prices up. So instead of betting on one winner, you combine them, because they don't fall at the same time. This is diversification. It means mixing assets so they don't move together to reduce risk without sacrificing returns. It is the only free lunch in finance. So, how do you mix your potatoes? It depends on your life stage. If you are young, time is your lever. You might go 80% stocks and 20% bonds. You can handle the ride for maximum growth. If you plan to retire in 5 years, defense is key. You might shift to 40% stocks, 60% bonds, and cash. Because you will need this money soon, you can't afford a big drawdown right before you start spending it. Finally, don't forget rebalancing. It's not predicting the market. It's simply bringing your portfolio back to your target allocation. Say you started at 60 to 40 stocks to bonds, but stocks rally and you drift to 75 to 25. It feels great until you realize your risk quietly increased. That's allocation drift. So you need a simple rule. Do a quick check once a year or check quarterly. If your weights move beyond a band, like plus or minus 5% from your target, you rebalance, trim what's gone up, and add to what's relatively cheaper. It sounds boring, but it's basically a built-in buy low, sell high button. Emotion removed. And yes, be practical. Transaction costs, taxes, and whether you're still adding new money matter. Often, the cheapest rebalance is just directing new contributions to underweighted assets. Investing isn't gambling, it's control. Start with a finance checkup. Fill your safety buckets, balance risk with stocks and bonds, and rebalance regularly. Build a system. That's how you can stay calm, beat inflation, and grow as a wealthy potato.